Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about IQVIA Holdings INC quarterly report. IQVIA Holdings Inc. offers a diverse range of businesses and services across three segments: technology and analytics solutions, research and development solutions, and contract sales and medical solutions. The company's key offerings include cloud-based applications and analytics, real-world solutions for life sciences and healthcare industries, consulting services in advanced analytics and commercial processes, outsourcing country-level performance metrics on pharmaceutical sales and prescribing trends, clinical trial support and project management, central laboratory, genomic and bioanalytical services, patient and site-centric solutions, healthcare provider and patient engagement services, scientific strategy and medical affairs services. These services cater to various industries, including pharmaceuticals, biotechnology, devices, diagnostics, and consumer health. The IQVIA Holdings Inc. stock price has remained relatively stable over the past year, with a minimal change of 0.83%. This stability can be attributed to several factors related to routine business updates and minor partnerships that are within the expected course of business for a global provider like IQVIA. Analyst reports with reiterations, minor executive appointments or departures, ESG updates, and participation in industry conferences without major announcements have also contributed to this stability. These types of news events typically do not signal a significant shift in the company's financial outlook, operational performance, regulatory environment, or competitive landscape. As a result, they are less likely to cause substantial stock price fluctuations. Instead, broader market trends may influence the stock's movement more significantly than individual news items. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in commercial solutions segment revenue by 5% and research and development solutions segment revenue by 4% contributed significantly to overall revenue growth. Additionally, technology and analytics solutions revenue saw increases across all regions, with a notable $14 million rise in the 3 months ended September 30, 2025. Constant currency revenue growth was also substantial, reaching $150 million, 3.9%, for the 3 months and $418 million, 3.7%, for the 9 months ended September 30, 2025. Furthermore, an increase in unbilled services by $35 million contributed to revenue growth, while accounts receivable factoring arrangements had a positive impact on cash proceeds. On the other hand, contract sales and medical solutions revenue decreased by $37 million, 6.4%, for the total revenues, leading to a decline in overall revenue. However, this was partially offset by an increase in selling, general and administrative expenses due to changes in compensation and related expenses. Overall, these factors demonstrate that revenue growth is driven primarily by increases in commercial solutions, research and development solutions, technology and analytics solutions, and constant currency revenue growth. Net income and profit margins experienced fluctuations in the period ending September 30, 2025. For the 3-month period, net income increased by $46 million to $285 million, while profit margins rose to 8.1%. However, for the 9-month period, net income decreased by $89 million to $847 million, and profit margins dropped to 7.1%. These changes suggest that the company's financial performance was stronger in the short term, but weaker over a longer period. The company's financial performance indicates a strong ability to generate positive operating cash flow. In 2025, the net cash provided by operating activities reached $1,514 million, demonstrating a significant increase from previous years. This substantial growth in operating cash flow is a testament to the company's efficient management and effective operations. The company's financial health has undergone significant changes in the past year. Notably, interest expenses have increased substantially, with a notable spike in the 9 months ended 2025, where it rose by $37 million, 7% increase. This trend is consistent across various periods, including the 3 months ended September 30, 2025, where interest expenses jumped by $19 million, 11.8% increase. Furthermore, the company's debt level has also seen a notable rise. Total debt increased from $13,966 million to $15,125 million as of September 30, 2025. This significant increase in debt is likely contributing to the substantial rise in interest expenses. The principal amount of debt outstanding and total indebtedness have also seen an uptick, indicating that the company's financial obligations are becoming more burdensome. The company's financial performance varied across different segments and regions. Notably, North America was a standout performer, as were the software sales segment and technology and analytics solutions. Research and development solutions also showed strong results. On the other hand, Asia-Pacific region struggled, along with the hardware sales segment. Contract sales and medical solutions also underperformed. Management is optimistic about the company's outlook, citing revenue growth driven by increased clinical services. They expect $8.1 billion in contracted backlog to convert to revenues within the next year. To adapt to changing market conditions, the company will streamline global operations and reduce overcapacity through restructuring actions, including consolidating activities and eliminating redundant positions. This strategy aims to drive volume-related increases in clinical services and position the company for long-term growth. The company's financial summary reveals that it has engaged in share buybacks as part of its equity repurchase program. Specifically, the program authorized a total of $13,725 million to be used for buying back shares. In this regard, 6.4 million shares were repurchased at a cost of $1,032 million. Concerns about inventory buildup and supply chain disruption exist. The financial summary highlights potential issues with inventory buildup and supply chain disruption. A significant backlog increase of $1.3 billion from December 31, 2024 to September 30, 2025, page 43, may strain supply chains and impact future revenue growth. Additionally, business disruptions caused by natural disasters and pandemics, page 35, could exacerbate these issues, indicating a need for careful management of inventory and supply chain operations. That concludes the financial summary for IQVIA Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.